Jared Getenga, who is the current CEO of CIS Kenya, is someone we have worked with all along from the beginning. When I met him, he was at the central bank in the bank supervision department. So we knew each other because at that time, I was still working I had just left KCB to start the journey of setting up an information sharing mechanism. I didn't know what it was, but I had an idea out of my banking knowledge and experience of what the country needed. Second gentleman is Peter Njuguna, the current CEO of SASRA. I also knew him when he was at Central Bank. Both gentlemen worked at Central Bank while I was working at KCB. So we sort of have joined, and today we stand before you to tell you what has the journey been about CIS, and how has CIS changed our economic life in this country in terms of access to credit, in terms of pricing of credit, and what does the future portend for this mechanism as we continue with that development. So kudos to the two of you. Kudos to all of you who have started embracing evolving technology in terms of how credit is actually administered in this country. We have made tremendous steps. We are way ahead of the curve, but there's a lot we need to do just to ensure that everybody is getting the benefit that they expect. Before I go to my slide, the credit has an important component of increasing your purchasing power. So if you have cash of 5,000 and you can get credit of 5,000, your total purchasing power is 10,000. If that cash is coming from employment, it probably will stay 5,000 for a year or two until you get a promotion or something happens. But the credit component, you can expand it from 5,000 to 10,000 to 50,000. So your purchasing power becomes 50,000, but the cash is 5,000, and the credit component is 45,000. And if we do that to most of the people in the economy, then purchasing power increases. Demand for goods goes up. Production goes up. Employment goes up. And life becomes better. So credit is an important component of any economy. And that's why we are serious about it. In other markets, credit has moved from being a privilege to a right, that you can't deny me credit, because it's a right. But if it's a right, it is expected that on your part, when you access credit, you pay back. So to my slides now, on what I had prepared for you, if you can move to the first slide quickly. I have only 30 minutes. What I look at is the lender's conundrum. Every lender has to go through a decision process that customer or that individual standing before you and asking you for credit or for money, you have to make a decision. And the key things that you want to look at is, will they pay you back? That's the question. Yes, you have the money, you have developed a credit product, but will they pay you back? Will they pay you on time? Money has a time value. If I say I'll pay you at the end of the week, and I don't pay you at the end of the week, I pay you after 2 weeks, there is something you have lost in terms of the time value of money. There's an opportunity cost that is associated with you not being able to take advantage of the money that you already have. So if somebody doesn't pay you on time, it's a cost to you. But of course, the third question to you is, will I make a profit? You are in the business of lending because you are expecting a return. So that expected return, if you don't make profits over time, your business will shrink and you will have to close. So you're looking at those three factors and saying, as I make this decision, I want to be sure that I'll get my money back, because that money has capital in it, the capital that you used to set up the business. And you don't want to lose capital in a business. You want your capital to keep growing so that your business actually is becoming bigger, better, and stronger. So if you're losing capital through your lending processes, then you have a real challenge about how the business is going to be. But those decisions are made under conditions that are certain, conditions of probability, conditions of uncertainty. So how do you know that this customer asking for a loan will actually pay back? Are you certain? Can you say 100% that yes, I know they will pay me back? In credit, it is not practical. Certainty is probably something we try to attribute to government and say, government issuing treasury bills, bonds, can say, I will pay you, because if the government is broke, they have the capability of printing money and they will pay you, particularly if it's domestic currency. They can do it. And even if a government changes, the incoming government has got to assume the obligation of the government that was there. So government, to some extent, will give you conditions of certainty, but we still know that even in the larger picture, governments do default. So all of those decisions come down to probability or uncertainty. Now, probability is to say, do I have experience? Has this event ever happened? You cannot calculate a probability on an event that has never happened, because one of the factors in the question will be 0. So the probability of it happening, if you don't have experience, is 0. Where it is uncertain, you cannot even measure. There's no experience at all. So credit decisions that we make, many of them, in respect to customers, will be under conditions of probability or uncertainty. And that is why it is always a safeguard to take collateral. That yes, you're promising to pay me, but as much as I want to rely on your promise, and I need an alternative option, an asset, a commitment that I can rely on that is totally out of your control. And that's part of what you do to lend. So from the outset, the activity of lending is a risky activity. So it carries two things: risk and loss. Risk is potential to lose, but it's not loss. A loss is a loss. So normally what happens is that credit moves from risk to a loss. And what you want to do is you want to minimize the credit that transitions from risk or risky credit to a loss. Because a loss, that money is gone. And so we focus on trying to manage risk, mitigate that risk, and say, can we keep all of our credits in the risk area and never go to the loss area? So that's what we have. Now, in terms of how your expectations for a return, remember, every loan you create is an asset to you, And the definition of an asset is that it creates cash flows for you. So the cash flows are the repayments. Those repayments are coming loaded with the principal plus interest. That interest is what contributes to your profit. So you have an expectation of how much you want to make out of every loan, and you charge interest. That expectation can be summarized by this small equation, that the required return or the expected return is the risk-free rate in the market, mostly set by the central bank. And that risk-free rate is what is usually given to T-bill rates. That is the rate that is sort of like the floor in the market. Then there's the market rate, which is the RM minus the RF. The RM is the market risk, market rate, which takes into account the risk in the market, the risk amongst borrowers. So the risk premium is then the difference between the risk-free rate and the market risk. So your total expectation will then be the risk-free rate plus the risk premium multiplied by a factor there called a beta value. Now, beta values are a measure of the the risk you cannot diversify from every asset. Every asset carries a risk. Part of what we do in risk mitigation is that you can create a portfolio, a diversified portfolio, and that diversification helps you to bring down the risk. But every asset has a component of risk you cannot diversify. And it is measured by a beta value. So every loan, every bond, every stock will carry that beta value. So when you multiply that beta value by the risk premium and add on the risk-free rate, then it gives you the expectations that you should have for the return that you should make. And that's where your actual story begins. Because if you do this, and for example, you find that the return you're getting is below even the market, the free market risk, then the opportunity cost that is accompanied by your decision is then a lot higher. You probably needed to have done something else other than giving out that particular loan. So that is what would basically inform the decision, the credit decisions that we make. Because at the core of it, that return is what will sustain your business. But we have several credit frameworks that we use to lend. The first one is, these are frameworks. These are not like formulas that have direct coefficients that you would want to add and say this. These are frameworks. The 5 C's of credit is a framework. So it tells you, if you're lending, look at these 5 C's: character, capacity, capital, condition, collateral. Look at all those things. They tell you something about the risk associated with this particular customer. Bankers use what you call Campari. It's still character, ability, margin, purpose, amount, repayment, and the insurance. Insurance is like collateral. That is their framework. We have now introduced another framework in the market called CIS. CIS is information that is pooled or shared amongst from customer credit behavior. So if you have that information, it gives you another framework that you can actually use to measure the riskiness of your customer. So these frameworks are there to help you estimate the beta value, which then you combine with the risk premium, and you are able to arrive at what you expect to make out of this. Now, this is applicable to all the lenders. If you are undertaking a lending activity, this is the foundation that sets up how you want to think about it. If we go further, is to say, because we know that risk can turn into a loss, and when you have a loss, the money is gone. Prudent lending will tell you that, can I recover that? Can I anticipate the loss and prepare for it? And how do you prepare for the loss? You price it. You price that loss, so that the interest rate you charge the customer has a component of a potential loss based on your estimation of the risk of that borrowing. And to help us in terms of how we price is to look at a relationship like this. And that relationship says expected credit loss is a function of probability of default and the loss given default. Loss given default is to say, if this customer defaults and I start the recovery process, how much do I stand to lose? So the simple way of illustrating is to say, maybe I gave a customer a loan of 1 million. I took collateral of 1 million, which secured the entire exposure. Customer has paid up to 600,000 and they have defaulted. So I go into recovery process. I need to realize the security of 1 million. I go to the market and I find that the value of that security has dropped to 400,000. So the only amount I can recover is 400,000. Outstanding is 600,000. And so if I'm lucky, I go and I sell the property, the security for 400,000, I will deduct from the 600,000. I remain with 200,000 that I now need to tell the guy, you know, that property you gave me only realized 400,000. You still owe me 200,000. Can you pay me? A long time ago, we used to say, we'll take you to civil jail. Yeah? So if somebody hears that, oh, you mean I can go to jail because I owe a lender money, that could probably shake them. And then they can call relatives. And the relatives will put up money and you get to your 200,000. It was a dicey thing because if you take somebody to civil jail, you have to maintain them. So it's sort of like you are going to incur a lot more expenses just to try and recover the 200,000 through that particular process. So probably most of the lenders will say, okay, I will write off the 200,000. So that 200,000 now becomes the loss. Given the default at 600, I have now lost 200,000 completely. So that's what we call loss given default. What will I lose if the customer defaults? And then, of course, the exposure at default is that at the time they default, what were they owing? They were owing 600,000 when they defaulted. I have lost 200. If I knew the probability of default, I would have priced my money in such a way the interest rate I give this guy takes into account that when he defaults, I lose 200,000. So the interest rate I charge must enable me to get that 200,000 upfront. That is how you do the business of lending. And in the current environment that we operate, which is now an environment that is pricing risk. So we need to know, how is risk being priced in this market? Central Bank has approved risk pricing formulas for all commercial banks. So if you're a bank, you got your formula approved, and that formula is what you use to calculate the interest rate you charge. That formula has that thing called probability of default. Probability of default is the measure of the creditworthiness of the customer based on their credit history. The credit scores that you get from the bureau are the measure of that probability of default. Because then they are telling you the chances, the odds of this customer defaulting are at this level. So if you get that score of your customer and the exposure at default, if you are giving the formula, the loan, you take the full amount. So I want to give you a loan of 1 million. I want to calculate my expected credit loss on you so that I price your loan properly. So I will first of all need your score. Then secondly, I will assume that you will default with the entire amount of 1 million. Then I need a value for the LGD. Some of the banks, some of the lenders, calculate LGD according to recovery prospects. How much do I stand to recover from here? So they go into their books and you look at that particular customer, if they have a history with you, how they have behaved for the last 3 years, 5 years, and you estimate and say, based on past history, what are the recovery prospects from this particular customer? That becomes your LGD value. So when you plug them in that formula, you will get what you are likely, the expected credit loss, and you can then now determine the correct interest rate to charge that customer. From a bureau point of view, bureaus are more specific as far as LGD values are concerned. And bureaus will always deliver a superior LGD value. Why? Because one, it is based on write-offs. What actually has been written off about that customer. So you share your data, Sacco shares data, banks share data. This customer maybe has 4 other accounts, MFI share their data, and we can see this particular customer has had a debt written off from the bank, has had a debt written off from the Sacco, has had a debt written off from an MFI. So we have real write-off data. And using that data, then we are able to estimate the correct LGD value. And because we have the correct LGD value, and we have determined the probability of default from the correct scoring, because again, that scoring is as a result of lots and lots of data that has come into the customer's profile from different lending channels. So again, it is based on pooled data. So you have pooled data on the credit history, and you have pooled data on write-off. If you plug it in this formula, you will get the correct ECL value. With that ECL value, then you can price your loan. And if you're pricing using this, then what you're saying, I have almost eliminated my loss values. Defaults will be there. Defaults will always be there. But a default is not a loss. When customers default, they simply have run into servicing or repayment problems. Some of them because a job has been lost or something has happened, but you enter into a recovery process before you reach the loss. But if you had priced this particular loan properly, you probably have recovered your money, because there's something we call a vintage analysis. When you give out loans, when do customers begin to default on your loans? If you do a vintage analysis, it will tell you that for a 12-month loan, probably you begin to see defaults in the 6th month. For a 24 loan facility, you probably begin to see defaults around the 9th month or 11th month. If you do it, there's an analysis called a vintage analysis that will give you portfolio behavior in terms of when do defaults begin to come into your portfolio. That's an important analysis you always need to do, because then it also enables you to understand the type of products and the associated risks with those products, and how you begin to change your credit management strategies based on your vintage analysis. And because of that, in common language, we call it loan fatigue. People get tired. So let me give you an example. In November, people are preparing for Christmas. Everybody wants to, in fact, these days, people plan by October, if you call Mombasa, you try a booking, you won't get. Because people are booked, people are prepared. Others have saved, others are going to borrow. So somebody takes a facility and say, I want to use this money to entertain my family throughout the Christmas period. At the time they are taking that, the appetite is very high. When they come back in the new year, so suppose they come to you and you give them a 6-month loan or a 1-year loan to enjoy their Christmas in 1 month. They will enjoy the Christmas and come back and begin the year. New problems come, school fees, whatever things are coming, they are bombarded with new demands. The pleasure of the holiday is gone. The motivation to pay that loan decreases, but with time. So you find that where they have a choice to say, do I pay this holiday loan, or do I now look at paying my school fees or doing this, you find that because you gave a long period, customers are getting tired in February, in March, in April. And you find that those loans begin to give you problems. Not because the customer doesn't have money, but they are tired. The value they are getting from that particular loan is long gone. So, correct structuring would say, I give you money for December, you pay me back in 2 months. Or maximum 3 months. Nothing beyond that. That way then, you are able to capture the spirit and get the customer to pay. So that vintage analysis is an extremely important analysis that we need to do to be able to understand how our loan portfolios actually behave. And we can calculate interest rates using this. So in this risk-based pricing environment, calculating expected loss is the only way you can price your loans properly. And that will mean that you got to have good quality credit scores, you got to have good quality LGD values. As an institution, relying on your internal data, relying on your internal scoring models, your accuracy is likely to be at a lower level because of what goes into scoring, the expansivity of the data points that we can get. The bureaus have data points that are varied. Utility, bank data, microfinance data, all of those are data points that go into the score. So it becomes sort of like a much more robust score than what you'd expect. Next slide. So in terms of the modeling, if we were to sit with you, and today in this market, you can't be so traditional. I mean, if you are still making a manual decision of lending 100,000, the cost to you of making that decision eats into your interest so much, because you have tools that can actually automate that particular decision. 100,000, 500,000, they are tools. They will be more accurate, because remember, as a lending officer, doing credit appraisal from morning to evening, from morning to evening, from morning to evening, you get tired. And we have seen that things like biases get into your decision-making process. And those biases are part of what impacts those NPLs. If you are not in an information sharing environment, it means you don't have visibility of your customer's credit history. You just have a bit of it. Again, that will introduce an error factor into your decision making. So decision making is getting automated, and automated in such a way that the data and the tools to process that data and give you accurate metrics that you can do are now available. I know SACCOs that we have been working with who are now automating their decisions. I know SACCOs that have realized the benefit of sharing full file information, because then that is ensuring that the probability of default of this customer is properly assessed. And we need to work with you to tell you how we get these LGD values so that you can commence the proper pricing of your credit. I know the models that says Sacco loans should be priced at 1% per month, which is 12%, and that you've run with that for a long time. And that is very attractive. Give 3 times the value of the member contributions. Those models, they have worked. In certain cases, they have not worked. But you are now exposed to what every other lender is doing, because you're going out and taking deposits from customers. Those deposits come at a cost. And so your model must be such that you must be able to cover the cost of funds from the income or the interest that you earn. One of the other things is to supplement that, probably you have to generate some fee-based income activities, services that you give to support your loan, your lending activities. Then that comes. For banks, we normally look at what is the fee to interest income ratio. Yeah? So you can get, in this market, you probably can get the fee is 45 to 55%, 30 to 70%. And that's a topic for another time. Now, in terms of how accounting helps you, these guys, accountants, have also looked at how lending integrates with credit. And for them, they value assets on the balance sheet, receivables. And they are saying, if you have receivables, if you have assets that have an expectation of a repayment, how do they want to assess risk? So you have IFRS 9 that now says, anticipate that loss. Don't count the loss after it has happened. And so accounting has also moved with the times. They say, anticipate that loss. If the probability of default is this measure, and for a period of 12 months, either provide for the entire thing or provide for 60% or some percentage of that particular loan before you give out the loan. So you will find that your provisions are supposed to carry components of anticipated loss based on this particular formula. So again, the accounting world has moved, the credit world has moved, and you need to be in tandem with what is happening in this. Next slide. So if you look at, in terms of the odds ratio, where you have 1-to-1, PD values are extremely high. It's 100%. You're expecting probably to lose 100% of that portfolio. So you'll be able to classify your loans. If it comes in that particular category, rejection is an automatic rejection. So you have subprime loans, which you need to look at and say, what can I do to be able to adjust my risk structure, price it well, and see how I monitor. Then, of course, prime loan and super prime. So that categorization, if we give you, let me tell you, if you come to our bureau and you've been sharing data, we'll give you a distribution of your customers' credit scores, 100%. So you know what category are in the loss area, what category are in this, what category are this. That we can give you. You can create templates that map incoming customers to say, how do they look like relative to this? But that is something you automatically get when you feed that data into our system. So there is a lot that the bureau systems can be able to do to support you in how you actually are able to categorize your customers. And that, where that advantage comes from is because of the vastness of the bureau data. Next slide. Next. Oh, no, this one. Go back. So there is a bank that asked us to go and look at their model, because central bank has approved their risk pricing formula. So we went and looked at their model and say, how have you developed your model? And how should you have developed it? So we looked at all the parameters. And what we found, based on their model, two things became clear. They were under-providing for their loans, and as a result, they were underpricing their loans. The price they were charging customers was not the correct price. When we looked at the NPL performance, there was a component there of about 3% that should never have been there because of how they had set their pricing models. Obviously, this requires a lot of analysis, comparatives, and the advantage is that we run that data through what we already have. So first thing for that institution was to say, let's validate your model first. How are you getting these PDs? How did you get your LGDs? That's when we discovered that banks are using internal data to estimate LGDs. That internal data is based on recovery information. And that introduces a significant error term in that whole process. Now, when we plugged in Bureau LGD, that is how and so we took a sample and ran that if you had used this model to appraise your customers, you would have charged this, and this would have been the outcome. And over 86%, that was accurate. That was accurate. And so we are now talking to banks and say, yes, central bank has approved your risk lending, but let's validate it. Let's look at what is going into that formula. Let's look at how are you getting the variables? How are you measuring them? Lenders today are structured into different approaches to the business they do. So you've got banks, you've got microfinance banks, you've got SACCOs, you've got DCP, digital lenders. So ultimately the product they give to the customer is the same. People end up taking loan products that puts money into their hands. And these people are in the lenders and borrowers are in the same market. They are interacting with all of these lenders. So the first challenge is visibility. How much of the of the borrower is the lender able to see? Because borrowers are taking credit facilities from different lenders. So if we do not have total visibility of this borrower, there are aspects of their behavior that we are not able to see and evaluate. And that then brings a challenge to the credit market, there is a component of risk that is not being evaluated. And that risk works with the customer. How can we ensure that we have total visibility of the customer? That to me would be the first thing to look at. The second thing is that we are structured in different lending approach because of, first of all, objectives and regulatory frameworks. So if you're a bank, you are regulated differently. If you are a microfinance institution, you belong to a different regulatory environment, a DCP, and objectives are also different. In terms of the risk component, those regulations have only taken into account how you should do your business. But in terms of what your approach to business portends from a risk perspective is not actually incorporated in the regulation. Because, for example, when I was asked a question about equity for Sacco lending. So yes, there is that approach that you must be equitable, you must treat your customers the same. But you realize that your customers do not present to you the same risk. So how do you then standardize products when the risk profiles are different? And what we know that if you are a lender, the higher the risk, the more you should charge. It's a risk-return relationship. If you're going to take a bigger risk on a customer, you go to charge that customer appropriately. So if the standard rules are telling you that these customers carry different risks, but you must treat them the same, that again presents us with a structural challenge in the market. So unless again that is addressed, we really can't say that we will be able to bring down this NPL. Then the third factor I want to say is the market perception. Just market perception that risks are high. And how do we generally have a conversation that is geared toward de-risking the market to deal with that perception? Where is that perception coming from? If you look at the NPL and you want to structure and say, let me dissect and find out what are the real causes of these NPLs. Will they be different from a customer who has borrowed from a Sacco, who has borrowed from a bank, who has borrowed from a microfinance institution, or they are generally of the same character? And therefore, they create a perception that overall, customers are carrying a high risk. So again, we need to have a way in which we deal with that market perception that customer risks are high. A lot of what I said earlier was, like when Central Bank was looking at banks' lending formula. So you go with your formula to the bank for risk-based pricing, and the bank says, no, you can't, your formula is wrong, because your cost structure generally is a high-cost structure. This cost structure is what is making you want to charge a high interest rate to customers. So that is specific to that institution. So that, again, is something that needs to be looked at. And we know that a higher interest rate contributes to high customer defaults. Of course, there's a threshold, there's a level that the marginal increment then sort of like goes, but we probably, that level hides somewhere between 2 to 5%, not 15, 20%. Thank you.
Thank you, Sam. And I think the thread also there is a challenge on managing the high interest rates, because when interest rates are high, it means the cost of borrowing is high. It means from ability to repay, eventually, if the interest rate is higher than growth in income, economists will tell you there will be default. So we have to really look at this NPL, cost of lending, as an industry, as institutions, because again, it could lead to adverse selection. Those people who are really not interested in eventually repaying, borrowing anyways, irrespective of the cost.